So, when investing, the crowd is almost always wrong. At the turning points when a stock changes direction, most wise investors are observing while those who are not react. And you see, most people in the market, they're not truly investing, they're speculating and guessing and hoping that a stock does something. They hear of a company with no earnings, no product, or no revenue, and they rush in, drawn by the promise of what might be. And while those are, hope and faith is good for a company to have, but success in the markets, it does not come down to hype. It comes from principle, discipline, and the intelligent use of tools. And I'm going to walk you through a few truths. I'm going to pull up the whiteboard here, and I'm going to do this on my iPad so you can have an idea of what we're looking at. But essentially, there's going to be 5 rules that we use every time we're investing in the market. And these are also things that will help you avoid all of the hype stocks, scam stocks, things like that you want to stay away from. You always got to be wary of the so-called get rich quick schemes, especially in a world where anybody can have an opinion and post a video online. It's so important to make sure that you have some principles that you work through. The first rule is if it's being shouted from the rooftops, you need to take a step back. When a stock is aggressively promoted on social media, it could be Discord and hyped up videos, there's no track record of that company delivering value to the world, that they are creating products that are serving the greater population or serving people that need that problem solved, then it's probably not one that you want to watch. So again, if everybody's talking about it, then it's not one that most likely is going to have that potential for you. It's the same reason that, there's consistently throughout many years through basically human history that humans have been divided into 2 groups. There's this 95% of the population who is the majority, and then 5% of the population who's just the minority of people. And they're both the same as far as their ability. They both are good people. The thing that you have to look at is what is the difference? And a lot of times in the 5%, why they're in the 5% is because they got the word. You might say, well, what do you mean they got the word? It means they were able to uncover the knowledge, they were able to get information or learn something that allowed them to serve people in a greater capacity, whether it's serving the 95% or serving the 5%, whoever they're serving, they've been able to serve more people and they've been able to make more money as a result. And it's not that both groups don't want to make money. They do. They basically have the same goal: make money or have financial independence and freedom and work towards doing something that is impactful in the world. And that brings us to rule number 2, which is what the company has from an insider perspective, the information that's being known from an insider perspective, so maybe that 5%, in what they do matters more than what is said about the stock. So if executives are early investors and they are selling shares while the public is buying them, then they are exiting. And you are essentially the buyer of the liquidity if you're buying from that group of 95%. So you have to look at things like the form filings. And I guess I don't need to pull up I could pull up the whiteboard here. But this is kind of rule number 2, which is you want to look at things like SEC filings. You can go to something like NASDAQ, or you can go, if you're in the cryptocurrency market, you can go to the wallets and see who the developers or the founders are and how the money is moving. You can actually track it on the blockchain. Beautiful thing. So essentially tracking insiders. Now, this doesn't tell you everything. In fact, a lot of times what can happen here is you just need to observe it and think about the reason why they would sell. Some of them have been holding shares for a very, very long time. Their salary might be smaller, and they want to reward themselves, and now the stock is at a high price. So it makes sense that they would sell. Doesn't necessarily mean something bad or something shady is going on, but that's something that can happen. And how do you know that that's happening? Well, if you have something like the CEO, for example, making an announcement that would drive the stock price up, and the CEO formerly was wanted for fraud or had some SEC run-ins and had a company in the past that didn't do so good. Now they're having a new company here and they're selling a ton of their shares, then that's a red flag. That's someone that wasn't operating with integrity. And you might say, well, that person's making a bunch of money. Didn't you just say that the most successful people are making that are part of that 5%? Are they successful people? Why don't I? What if I don't like that person? Because this is a thing that happens, right? People say, I don't like the 5%, but that's not the key. You see, some people have money and they use it as a tool to serve the world and continue to do amazing things in the world. Other people obtained their money through means of which weren't maybe of integrity. Does that mean that they're successful? I don't believe so. In fact, just because you're in the 5% doesn't always mean you're successful. What determines your success is if you have a progressive, worthy ideal that you're working towards and that you are pursuing and making progress to that is a good impact in the world. So those people, just because they're CEO, just because they have a lot of money, doesn't mean that they're crooks. It just means that they are most likely serving the world in a greater capacity. But the definition of success could be the school teacher that's happy teaching school or the coach that's happy coaching kids. It's not always a measure of financials. So keeping that in mind. So the third rule, and this is a very key thing. This is rule 3. That was rule 2. Rule 3 is a good company creates value, real value, and a bad one creates more shares. It's not always bad that companies dilute or sell shares. In fact, sometimes they need to raise money in the initial stages because they're building something that's very ambitious. But some companies issue stock, and this is, so let's just write it down, a good company, we'll just write it like this, a good company issues value to the marketplace. A bad company issues shares. Not always is that perfectly lined up. And the reason why is because, again, sometimes they have to sell shares in order to make money for the balance sheet. But if you see a public offering constantly raising money, that could be a potential red flag. So like constantly raising money. If you look at a company like Amazon, once they raised their initial money and they got going, they didn't need to keep raising money. In fact, when investors pulled out and their stock was tanking, they were like, oh, it's fine. It's totally fine because we're already operating well. Does our balance sheet say maybe that we're not operating at a profit because we're pouring everything back into the business? Yes, but we're okay. And so if they're constantly raising money, that's not a good sign. If they dilute your position, usually not a good sign. So if they dilute you or others. And it's okay to do that, but if they dilute you and grow nothing of value in return. So if they dilute, but then shortly after come out with a very great product and a very great announcement, and they're bringing a ton of value to the marketplace, that's good. But if they dilute you, they're issuing shares, they are constantly raising money, then most likely it's not investing that you're looking at in this company. It's just silent theft. I'll give you an example. There was a company that I was investing in a while back. And the first thing or I didn't invest in them. They were a private company. It was private venture that I was potentially going to invest in them. And when they came to me, they showed me what their technology was. They told me about all these other investors that were coming to invest and that they had pipelines lined up and that they were closing this round. And I remember, I was fairly young. I think I was 23 at the time, but I had some means to potentially invest in this company that would really put them into a position potentially to make more and get some key employees that they needed. And I went on a call with them, and they ran down what I was investing in, and it was like a $30,000 investment or $50,000 investment. And I said, great, I'm gonna if you can send me over the details of the value you guys are currently providing to the marketplace and how you're serving them and where you plan to serve them, then most likely we can get started if that all lines up. Not only did they not provide the real proof of where they were going to see that money show up, but then shortly after, I see a video on social media that they were telling me in the meeting they had raised money from some other investors here, and that they were out at the club and they were celebrating with their Dom Perignon or whatever in Miami or something. And I was like, that is fine to celebrate, but there's a balance. You don't have to go lavish. You don't have to go so crazy with your celebration, especially when you're raising money. And one of the key indicators of a company that's growing is that they continue to develop and put back into their business and continue to invest and cut their debt down as much as possible, continue to grow. So seeing them cut debt is usually a good thing and not create more debt and more liabilities. So again, if those things don't line up, it could not be investing, it could be theft. So this is rule number 4, which absolutely changed the way that I invest. And a lot of people make this mistake. And it's really broken down into a few categories, A, B, and C. And it is based on essentially volume without substance. So a really good example was a stock we covered a while back. It was called KULR. It was this company that was providing batteries to space companies to launch up into space that were highly resistant to extreme temperatures. So they had some thermal conductivity technology. They had some small partnerships with NASA, and they were getting ready to launch with SpaceX. Now, at the time, there was a ton of volume, insane amounts of volume, but they hadn't actually launched their mission. Their net income was still negative, and they started doing all these new things, like every single little trend from the Bitcoin shares to the robotics to changing their name to an AI company to doing drone technology when they only had like 50 employees or 100 employees or less, but they were expanding into all these huge markets. And they didn't have any substance, any big contracts or anything that would really show why they were seeing such huge volume. It was more hype. So that's kind of A. It is essentially unjustified volume. There you go. And B is more liabilities than assets. So any company that's operating with more liabilities than assets, if at any given time the banks or the lenders that they have for those liabilities want their money and they want to request to get that money back. Is it 1L? I think it's 1L. Liabilities greater than assets. So what it means is those loans could be required to be paid in full. And if that happens, then they don't have enough assets to sell to be able to pay off all those loans. So essentially what happens is you have a company that goes bankrupt. Now, bankruptcy is a beautiful thing because it allows entrepreneurs to go out and take chances and invest in their company, and that, yeah, they potentially can lose it all, but they could be protected. In the past, if something like that would happen, in fact, in a lot of other countries, if that happens, you go to jail. But in the United States, the way that we have it set up is you have to go through some hardship, but you're not totally out of the game and it's the end of your life. And so bankruptcy is a good thing, but it's also not a good financial health risk to see the potential of when investing in a company. So if liabilities are greater than the assets, that's not good. How do you check that? You can use a simple tool like the internet, go to the Google Finance or the financials of the company. It's called the balance sheet, and it will show you the liabilities versus the assets. And if a company's on the blockchain or something like that, usually they provide it if they are fairly legitimate in their financials. And then C, so volume without substance. So again, the last thing we look at there is going to be that the amount of coverage, the views, basically the views are high, or the volume is high, the amount of buyers are high, but the income is low. You're going to want to see income being something that makes sense, especially even in a short-term investment. That gives you that ability to, if you can't answer that question and see that their income is increasing or that it's getting better, then again, you might not be investing, you might be gambling because the company hasn't demonstrated that they're growing. And if the earnings aren't making sense or the news still hasn't really showed up, you got to ask yourself, what am I not seeing? Like, who is benefiting here? And it means that you're putting money into a stock that hasn't demonstrated that value to the marketplace. So here is rule number 5. Rule number 5 is to always know what you own and realize that it's better to know why than what. So if you're investing in something, most people that are not having success will ask the question, what do I buy? When should I buy, sell? What should I do with this stock? What do you think about this stock? Versus the why. Because if it's tell me what to buy, figure out, tell me what I can do, you put yourself in a really, people that do that put themselves in a very tough situation because now they're relying on somebody else to give them the information to make a decision who they don't know the intentions of. So what you want to do is rather than get information about what to buy, learn the skills to identify why you would buy something. So a real investor, the Warren Buffetts, the Charlie Mungers, they study the numbers. So studies numbers, and they look at the people behind the business. Is there a notable reason why that company would grow with that stewardship or that leadership? So that's a key there. Now, the wise investors that I know study the reality of the business. A lot of times, what happens is if there's a scam or there is a investment that would be undesirable for someone trying to find real value, it would be a company that shares with you all of the cash, all of the money, all of the like this is where the stock could go. They're really focused on the stock and telling you you're going to make money. They're really focused on, for example, the emerging trends that you can't that they're going to somehow serve to you. And essentially, you want to take a pause, not look at what's exciting, because they're going to say this is the most exciting thing. You have to get it. It's very hype. It's very emotional. So you have to take a pause and you have to say what's not exciting, what is enduring, what is value, and who would I be to be investing in this company? Because you want the roots, the intrinsic value to be so good that it's not something that looks like a 6-month opportunity, but it looks like a 5-year opportunity, and that you could invest in it for a few months or something like that or longer and be able to capitalize on what would be institutional and attracting value. Then that puts you in an advantage. And so institutional attracting value and where the money's going to really flow, if it's hyped, it may have already gone up. So when you always know what you own, you focus on principles that are just like a huge oak tree, right? You're getting your roots in, not noise, but it's got this this calmness, this calm. It's almost like a quiet power that's really developed for the world, and it's empowering people. It's empowering. If the company isn't having this like steady, calm, quiet power that's being built, then it's not empowering, then it most likely is something that is very much hype. So that's rule number 5. If you guys want to see our daily investing where we trade every morning at market open in our live sessions, it's the second link in the description for Stockmates. You can kind of go through this flow. If you want to grab this entire whiteboard along with other things we've covered like risk to reward, emotional control. We also go into setting a trading plan or investing plan, asset allocation, with the exception of maybe not the best handwriting here, accounts and how we invest not just into all the individual categories and things in your life, but also the allocation of those accounts and splitting them up between cash and crypto and assets so they work while they're sitting in the accounts for you, or just how to balance your assets and your liabilities and increase them so that they can grow your income and exceed that of your expenses for more freedom. So if you guys want to learn more about it, there's also the first link in the description for the machine. We recently launched this tool that's built on all of these principles, but it utilizes AI to help you analyze stocks and assets. And it helps you it's really designed for investors to see exactly where a stock most likely would go with the value that it's creating in the marketplace. So if that's something you want to take a look at, again, it's the first link in the description down below. Hopefully I earned your thumbs up. Thanks so much for watching, and I'll see you in the next one.